An investment company known as a management company, and my example will use Dreyfus, Scudder, Van Kempen, T. Rowe Price, Fidelity, are companies that manage client money by taking client investment capital in dollars and invested it into what are known as funds. So the security that we're talking about here is called a fund. But the proper security name is called a packaged security. Why are funds known as packaged securities? Well, when your client buys shares in a fund, these are not common stock shares. Are you with me so far?
Yes.
They are either open-ended shares or closed-ended shares, and we'll get into that language in a minute. He's buying an investment in a fund, and in that fund there is an underlying portfolio of securities, usually stocks. Are you with me so far?
Yes.
So when we talk about a packaged security, which is the entitlement of this language of this particular security and chapter, are you with me so far?
Yes.
Where's the package? Well, the package is the makeup of what is known as an underlying portfolio of anywhere between 38 to 42 stocks that are built into a fund. Now, each singular share that you buy, go out buy one share in a fund. Are you with me so far?
Yes.
And in that fund, there are, for example, 38 stocks. Are you with me?
Yes.
That one share that you bought, one share, in that fund that contains a package or an underlying portfolio of 38 stocks that's built into that fund. Are you with me so far?
Yes.
That one share, watch this now, equally and undividedly, very powerful words for you, owns the same percentage of each one of those 38 stocks. So that would mean that mathematically one share represents 1/38 of a percentage of equity ownership. That one share that you bought in that fund that has a portfolio of 38 stocks owns the same percentage equally of each one of those 38 stocks. Are you with me so far?
Yes.
Why buy one tech stock when you can own a piece of 38 with one share? Are you with me so far?
Yes.
Why buy one large cap blue chip stock when you can buy into a large cap blue chip fund and own a portfolio of all 38 stocks through one share of ownership? Are you with me so far?
Yes.
So what's so exciting about investing in funds? Well, you would get Series 7 Bullet 1 portfolio diversification. One share, to use one share as an example, represents ownership in the entire portfolio. Significant way to grow your investment. The company, the management company that's managing your money, managed assets. You're dealing with securities here that are managed products. When you meet with somebody, I only trade and buy and sell and invest client money into managed securities. Managed securities are securities where the issuer, my example, Dreyfus, is managing the client money. Mr. Johnson, you don't have to worry about your money. Your money is invested into a technology fund. You own a piece of an entire portfolio of technology stocks. Are you with me so far?
Yes.
We'll manage your money. We'll buy shares for you when you want to accumulate a position in that fund, and we'll sell shares out of the fund and send you money when you want to receive your money. We're managing your money for you. You don't have to worry about it on a day-to-day basis. What's the second advantage of buying into a fund? 7, professional management. Mr. Johnson, your client, and most clients tap into their investments in funds and liquidate out of a fund, usually during certain periods of time of the year. Let me tell you, when the client is going into and seeking a liquidation mode. Are you with me so far?
Yes.
And why is he going into his mutual fund portfolio to liquidate? Look at me, because that's where he has most of his money. Are you with me so far?
Yes.
Holiday selling. He's going to go into that fund. You're going to see in November, you're going to see prices go down in funds in the market. This is historical. Are you with me so far?
Yes.
Because he taps into his mutual fund portfolio for the liquidity for the financing of holiday periods of time. Are you with me so far?
Yes.
When else? April. March, April. He's going to go into the fund portfolio to liquidate money in the fund to pay for his IRS tax liabilities. Are you with me so far?
Yes.
You can time the performance of how mutual funds and their pricing occurs in the marketplace during holiday and tax selling, because that's when he goes into where his real assets lie. Now, we talk about money invested in funds in the market. Are you with me so far?
Yes.
When we talk about mutual funds, it's the first time I said that to you here today, and we're going to be talking about the language of mutual fund trading, and we'll see why mutual funds are called mutual funds in a moment, as opposed to what other type of funds? Closed-ended funds. We're going to get into their distinctions in a moment. I would like you to know that the makeup of the underlying portfolio of securities built into a mutual fund is 7 common stock only. Look at me. Common only, as a security of type. As far as the industries are concerned, that's based upon the name of the fund. Are you with me?
Yes.
What about the biotech mutual fund, all biotech common stocks? What about the large cap blue chip mutual fund, all large cap blue chip stocks? How about the energy fund, all energy stocks? You will build an energy portfolio for clients. You will build a homeland security portfolio of all homeland security stocks. Have we so far?
Yes.
How about the technological fund, all technological stocks? The banking fund, all banking stocks. The healthcare fund, all healthcare stocks. The name of the fund determines the underlying portfolio. 7, by class, which goes to industry. By type, it's only common. Stay with me. Are you with me?
Yes.
So, we talk about how much money is invested in the market in mutual funds. Are you with me so far?
Yes.
Looking at the assets. Listen to me carefully, because this is over and the top and beyond the 7. Are you with me so far?
Yes.
And that's another way of saying how much money is invested in common stock. When we talk about how much money is invested by investors in common stock in the market by investors, well, isn't that another way of saying in mutual funds in common stock? Are you with me so far?
Yes.
Because common is the makeup of the security by type. Are you with me so far?
Yes.
Almost $5 trillion is invested in common stock in mutual funds in the market. Are you with me so far?
Yes.
That's where the bulk of assets are invested in common stocks. Not in isolated common stocks regarding isolated common stock investments for clients' portfolio trading, but in mutual funds in common stock. Are you with me so far?
Yes.
That's why the amount of money that's measured, invested in mutual funds one month to the next, is known as, statistically it's called cash inflows. How much money is flowing into the market in mutual funds which is invested in common stock. Are you with me?
Yes.
Now, why is that an important statistic? Because that statistic, how much money is invested in mutual funds in common stock in the market measured from one month to the next, is one of the 4 corporate characteristics known as the 4 horsemen of the apocalypse. You got to listen to me. You have to forgive me, because I just coined the phrase for you that and phrases that are older than 200, as old as 200 years in this industry. Wall Street loves to coin phrases. Buy into weakness and sell into strength. Where there's a bull, there's a bear. The greater the risk, the greater the reward. I said the 4 horsemen of the apocalypse is another way of saying the 4 characteristics that, if they do occur in the market, moving in synergy together like a steam engine in the direction I'm about to show you, if these 4 characteristics occur in the marketplace, moving in the direction I am about to qualify for you, this is beyond the 7, you have what are known as the criteria of a bull market and a bull run. And you're going to see now why we are not nor have been in a bull market. Are you with me so far? What are the 4 core characteristics that the market requires to work in synergy together in order to be considered a bull market? First thing you need, and this is by order of priority, by the way. Are you with me so far? For a bull market and a bull run, is you need low rates. Why? Well, because when interest rates are low, interest-bearing securities like bonds, are you with me so far? The fixed income market are unattractive. I told you, and I'll teach you when we get into week 3 of the fixed income bond market, that any interest-bearing security that pays less than 4%, which is significant out there in the market, actually has the client lose 1.25 to inflation and taxation in his net returns. Are you with me so far?
Yes.
Based upon this level of inflation in the economy. And so we have interest rates that are lowest in almost 47 years. If they go any lower, we're going to have negative rates. You know it and I know it. Am I right?
Yes.
So that means we're not putting money into the interest income marketplace, the bonds. And so when the rates are low, like they are right now, where are clients directing their capital investments? Into the equity market, and that would give liquidity into the stock market. And so that's the first requirement of money invested in the stock market. And that's only going to happen when rates are low. So we got that component of a bull market. Are you with me so far?
Yes.
But the second requirement is that earnings, you know this, which are corporate profits and stock prices, drive the marketplace with profits. Are you with me so far?
Yes.
And that profit picture really hasn't been as strong as it's really required for a bull market. Are you with me so far? So here's your first problem with the criteria of a bull run. The increase of the strong and consistent level of corporate profitability which drives stock prices. Are you with me so far?
Yes.
For the appreciation of the performance of a bull market. Look at the third characteristic, most important of all. Even though they're all important, but one of the most important characteristics of the 4 here. You need, for a bull market, an increase in consumer spending. You want to know how important that statistic is? Let me tell you how important it is. Do you know that consumer spending represents 2/3 of the entire U.S. economy? Are you with me so far?
Yes.
Listen to what I'm telling you. 2/3 of the entire U.S. economic outlook is measured based upon consumer spending. And we don't have a lot of consumer spending. We have a lot of consolidation and hoarding going in the marketplace. We have 5.7 million jobs that are lost with a lot of displacement in the earnings and the income are not there. Are you with me so far? Yes. We have a frozen credit market. We're not spending. We're not lending. We're not borrowing. America is built on capitalism and borrowing. Are you with me so far? Yes. There's your second problem to a bull market, which is why you're not in one. Are you with me?
Yes.
Look at the third characteristic. More new money, an increase of new capital coming in from one quarter to the next, measured quarterly, into mutual funds, which is another way of saying common stock. Are you with me so far? When those four corporate characteristics, those four pillars, those four horsemen of the apocalypse are working in those directions, together in synergy, you have a raging bull. That's what you had for 10 years, from 92 to 2002, and that's what you don't have right now. Are you with me so far?
Yes.
Just what you'd like to know, the characteristics of a bull market. Are you with me so far?
Yes.
You okay? We're both dying over here today. So let's talk about funds. Are you with me so far?
Yes.
We have a Securities Act that regulates the buying and selling and trading of mutual funds. Why? I can't really think of a significant and segregated Securities Act for every security. Why this particular security? Because almost $5 trillion is invested in common stock in the market, and that's why we have an act that regulates the buying and selling and trading of mutual fund shares. We'll talk about fraudulent European market timing on the closing of mutual fund prices here in the United States on the previous day from the European markets when we get into this regulation. Are you with me so far?
Yes.
But let's talk more about the characteristics of this particular security. I want to talk to you about American Century. American Century was the very first management company known as investment company. Look at me. When I say investment company, I'm talking about the management company. I'm talking about Dreyfus. I'm talking about Scudder. I'm talking about T. Rowe Price. I'm talking about Fidelity. These companies are not broker-dealers. They're called management companies because they manage client money when you invest in one of their funds. Now, every one of these management companies has anywhere between 50 or 60 different types of funds that are offered out there for sale. Are you with me so far?
Yes.
From Fidelity to Scudder, to Van Kempen to Dreyfus. And the name of the fund determines the underlying portfolio built within by type, which goes to industry, or by class. It's common for mutual funds. Are you with me so far?
Yes.
The reason why I talk about American Century as opposed to Dreyfus or Scudder or Van Kempen is they were the very first management company that created the very first fund, are you with me so far,
yes,
in industry, for clients to invest to put away money for educational funding. Are you with me so far?
Yes.
But we know the names of these funds. Now, I have the prospectus here. What did I just say to you? Prospectus. Why are mutual funds sold by means of the vehicle of prospectus? Because you're dealing with Series 7 common stock. And common stock, whether it's in the form of a package built into a fund or an isolated common stock recommendation, is sold by the means of this vehicle. Am I right?
Yes.
Look at this prospectus associated with Pilgrim, recently bought out by ING, management company like Dreyfus. How about this one? You're going to love this one. This is Munder, maybe a name you don't know. Why do I bring up Munder and show you their prospectus? I'll tell you why. Because Munder is the very first management company that created the very first internet fund called the Munder Net Fund, which was made up of all internet common stocks. Are you with me so far?
Yes.
And manage those assets with their investment advisor. Every fund is assigned an IA known as the investment advisor, who is the key to the performance of the fund, regarding the returns of the fund. Are you with me so far?
Yes.
Because he's the fund's manager. He selects the specific securities that the assets in the fund are invested in. He trades those securities. Are you with me so far?
Yes.
She identifies political, economic, and market risks and generates returns to the client based upon his timing and selection skills. Are you with me so far?
Yes.
An average fund has about $6 or $7 million in assets. That's a small fund. Good sized fund, 20, 30, 40 million. Are you with me so far?
Yes.
Good sized funds in assets, which are the dollars invested in a portfolio of 38 or 42 stocks built into that fund. Which fund that's offered out there for sale by which management company is the largest fund on Wall Street out of more than 7,000 funds in aggregate that's offered by all of those management companies for sale to the open market? The name of the management company is called Fidelity. Are you with me so far? The name of the one fund out of all the funds that they offer for sale is Magellan. The asset base is well over $100 billion. And one individual manages that asset base. I call that a tall responsibility, wouldn't you? It's the largest fund on the street of dreams. Now, you're on the phones with a client, look at me, and your client says, listen, I think we should start talking about putting away money for educational funding. You know, my children are young, so the one thing I have on my side is time, because they had not even in high school yet. So we should start with the vision of thinking about that now. I have a little liquidity. Which fund do you recommend? There's more than 7,000 funds that are out there. Are you with me so far? You'll be doing due diligence all day. Are you with me so far?
Yes.
Right. Don't be passive. Kind of trade with me. You'll learn better. Now, I want you to know out of the 7,000 funds that are offered out there for sale by all management companies, more than 2,500 are growth funds. Are you with me so far?
Yes.
Now, why do I bring up that type of fund? Because you already identified your client's investment objective the minute he told you he wanted to put money away in assets for educational funding because his children are young. He's got time on his side. Even so far, it's about the only advantage he's got. And so therefore, because he's got time on his side and he doesn't need that financing for 15 or 17 years from today, are you with me so far?
Yes.
You've already identified which type of fund to invest in. That is growth funds, which has a make up the underlying portfolio of growth stocks. Are you with me so far?
Yes.
The name of the fund, the underlying portfolio by class, which goes to industry, type is common. Are you with me so far?
Yes.
Okay, there's more than 2,000 plus growth funds that are out there offered for sale. Which growth fund do you recommend? Well, you'd like to recommend the fund that's got the highest returns in the market. Am I right?
Yes.
Well, I want to tell you where to go to cut your due diligence time to a 16th. Are you with me so far?
Yes.
I want you to go and write this down because this is over the top, and I want you to have it at Morningstar.com. Morningstar.com. This company, Morningstar, is based out of Chicago. They are the most prestigious fund credit rating service in the industry. They rate and rank the performance of thousands of funds. They got the top 5 funds in the market, super funds, platinum funds, funds that have outpaced the returns of the market. You with me so far?
Yes.
So if you go to Morningstar.com, you can start out with the best 5, if you will, growth funds, if you will, or technological funds, or banking funds that fits your client's investment objectives, and issue those recommendations to start out with some of the best performing funds in the market. Are you with me so far?
Yes.
Great. Well, I think we feel a little comfortable with this particular product. And so now let's go into talking about Dreyfus. Dreyfus has never had in their 50 or 60 different funds that they offer for sale an international equity fund. They would like to have that added to their product line. Are you with me so far?
Yes.
That would be a makeup of 38 or 40, if you will, international equity stocks. Are you with me so far?
Yes.
So it's a global fund, if you will. There are 500 million shares in this new offering that Dreyfus is going to sell to the open market regarding this new fund that they would like to launch. Are you with me so far?
Yes.
Please look at me. When the management company sells the 500 million shares in this offering of this fund to the open market regarding international equity funds, are you with me so far?
Yes.
Shares. We want you to know, I want you to know that once they issue those shares to the open market for sale at the IPO level, are you with me so far?
Yes. Yes.
The offering is a continuous offering. The shares that Dreyfus is selling to the open market is a continuous sale. Are you with me so far?
Yes.
I mean, there's no end. It's open-ended as to the issuance of these shares. Are you with me so far?
Yes.
Mr. Johnson, would you like to buy shares in this fund? Well, if you would like to buy shares in this fund, Mr. Johnson, I'd like you to know that in the prospectus, please look at me, there's a section called the application. Are you with me so far?
Yes.
Now, if you fill out this application and you have your checkbook and you send the check in, and send in the minimum dollar requirement that most funds require, known as the minimum investment. Some funds require a minimum investment of $100, some funds $250, some funds $500. I want you to send in the minimum investment, fill out the application, and send it directly to us here. Are you with me so far?
Yes.
You would own an investment in a portfolio in a fund by tomorrow. Are you with me so far?
Yes.
No one from the management company is going to call clients up and solicit their assets. That's a transactional function in the business of brokerage. They don't have a sales force here at Dreyfus. Are you with me so far?
Yes.
Now, you can buy shares, Mr. Johnson, directly from the management company. They're going to issue and sell shares directly to you. Are you with me so far?
Yes.
These shares are called open-ended shares. And because the offering is an open-ended, continuous offering, and sale of those shares by the management company to the open market. Mr. Johnson, when you would like to liquidate your shares, sell, are you with me so far?
Yes.
Only the word liquidation is not used when it comes to mutual fund trading. The word for sale or the liquidation of shares, are you with me so far, is known as Series 7 redemption. Please get this language down. Why? Because if I looked at you and you looked at me and said, listen to me, I think I'm going to be executing some redemptions in the marketplace regarding my client investments. The minute you use that word redemption, I know you're talking about the sale of some client's mutual fund shares. Every one of these products and every one of these strategies has their own basic and inherent and specialized language. Are you with me so far?
Yes.
The language of money and flow through tax treatment of tax shelters and limited liability for limited partnerships. The language of mutual fund trading. Every one of these, the language of redemption. These products have a specialized language. Friday's no exception. The language of writing contracts means selling. Why don't we say selling? Because the minute we use the word writing or to write, we're talking about derivatives. Am I right? Every one of these products has their own specialized language. And so, Mr. Johnson, when you would like to redeem your mutual fund shares, client wants to liquidate, he wants liquidity. You with me so far? Yes. You can sell those shares, Mr. Johnson, directly back to us here, the management company. We'll take the sell order in and give you the bid. Why are these shares, known as open-ended shares, called mutual fund shares? Because they're mutually bought and sold between the client and the management company on an open-ended basis. Are you with me so far? Yes. That's where the word mutual comes from. Mr. Johnson, we stand ready, we here at Dreyfus stand ready to issue and sell those shares directly to you. And we stand ready to redeem and buy back those shares when you want to redeem and liquidate. Are you with me so far? Yes. Mutually between the client and the management company. And that's where mutual fund shares gets its language from. What are mutual fund shares? Open-ended shares. Only open-ended shares, Series 7, are known as mutual fund shares. Are you with me so far? Yes. Now, when Mr. Johnson goes out, Mary Smith goes out and accumulates a position and buys shares in a fund. Are you with me so far? Yes. Your client will always pay 7, the offer price. Agreed. Yes. Agreed. Yes. That's known as the public offering price. From now on, that'll be known as, if you will, POP. P-O-P. POP stands for the public offering price. Pay the offer to go long. Am I right? Yes. And when your client redeems or liquidates any security, what does he always receive? The bid price. Am I right? Yes. Pay the offer to go long a position in the fund or in any security. Receive the bid price when you liquidate or here when you redeem. Agreed? Yes. So, let's talk about some of the characteristics of open-ended shares. These are shares that are issued to the open sale marketplace by a management company who acted in an open-ended capacity. And acting in an open-ended capacity means that Dreyfus, when they sell those shares to the open market, these shares are issued on a continuous open-ended offering basis. There's no end to their sale. Are you with me so far? Yes. They're constantly issuing those shares for clients to buy, and they stand ready to buy back and redeem those shares when the client wants to redeem. These shares can be purchased directly from Dreyfus. Are you with me so far, the management company? Sold back and redeemed to Dreyfus. Are you with me so far? Yes. Or they can be purchased or redeemed, bought from, sold to Dreyfus's sponsor network. Are you with me so far? Yes. What is the sponsor? It is the distribution network that the management company seeks. The one thing that these management companies don't have is a sales force. Am I right? Yes. I just finished telling you, nobody at Dreyfus is going to have a sales team there calling you up and solicit you to buy into Dreyfus's mutual fund shares. Are you with me so far? Yes. So what do you think the management company requires? They require the Goldman Sachs, the Merrill Lynch of the world, the broker-dealers of the world, are you with me so far? Yes. To act as their sponsor and distribution network. Munder's going to come down, Pilgrim's going to come down, Dreyfus is going to come down and say, Lehman, Morgan Stanley, Dean Witter, will you act as our sponsor and distribute and sell our shares in our funds to your clients? Are you with me so far? Yes. The Investment Company Act of 1940 requires that the broker-dealer sign an agreement with the management company whereby Dreyfus is authorizing Morgan Stanley Dean Witter to act as their sponsor. Are you with me so far? Yes. Distribution network. So, if you look at the Munders and the Ings and the Pilgrims of the world, they have 30, 40, 50 different investment bank broker-dealers as their sponsor network, buying and selling and trading their mutual fund shares for those management companies to their clients. Are you with me so far? Yes. Mr. Johnson, you can buy shares in an open-ended mutual fund directly from Dreyfus or from Lehman or Morgan Stanley, Dean Witter, or Goldman Sachs. They'll sell those shares to you. And when you want to redeem, you can redeem those shares back to us here at Dreyfus. We'll take the sell order and give you the bid. Or you can redeem those shares right back to Lehman or Morgan Stanley, Dean Witter, our sponsor network. Are you with me so far? Yes. These shares are redeemable shares by the management company, Dreyfus, or Morgan Stanley, Dean Witter, the sponsor network. They are known as mutual fund shares. We're talking about the characteristics of open-ended mutual fund shares. Are you with me so far? Yes. And of course, when we get to the pricing of mutual fund shares, open-ended shares, you'll see that the components that make up the price of one mutual fund share that the client may want to buy are different than the components that make up the price for one closed-ended share. Are you with me so far? Yes. Before we get into pricing and valuation, let's talk about Munder. I said this was the very first management company that created the Internet Fund, known as the NetNet Fund. Are you with me so far? Yes. Guess what they just created not too long ago? The Munder International NetNet Fund. What do you think that is? International Internet stocks. We were talking about the break about Chinese, Asian Internet stocks. Are you with me so far? Yes. This entire portfolio in this International Internet Fund, are you with me so far? Yes. Is all made up of global international internet companies. Are you with me so far?
Yes.
Now, when Munder issued these funds, these shares in this fund for sale, are you with me so far?
Yes.
What if I told you there's 250 million shares in this offering? Are you with me so far?
Yes.
This is an international net fund. Are you with me so far?
Yes.
When the management company issues the 250 million shares in this fund for sale to the open market, once the 250 million shares are sold to the open market, look at me, the fund is closed out for sale to new investors. There are no more shares available for sale. The only amount of shares that are available are shares in the offering. Let me so far.
Yes.
Mr. Johnson, I want you to know this is a one-time offering of these shares to the open market. Once the number of shares in this offering have been issued and sold to the open market, the fund is closed out for sale to new investors. There are no more shares available for sale. Mr. Johnson, would you like to buy shares in this closed-ended fund? We're not selling those shares to you. You have to buy these shares from the open market where they trade, on the NASDAQ or on the New York Stock Exchange. And whenever you go out there to purchase any security in the open market, you will pay the market price. 7. Market price. These shares, known as closed-ended shares, purchased in a closed-ended fund, are you with me so far?
Yes.
Are made up of the market price. Because that's the price you pay when you go long any security out there in the open market. Now look at me, Mr. Johnson. Would you like to redeem your closed-ended shares? Look at me. You want to sell your closed-ended shares, some of them or all of them? You can't sell those shares back to us here at Dreyfus or Munder. We're not taking the sell order in. These shares, closed-ended shares, please listen to me carefully, are non-redeemable by the management company or the sponsor network. You have to redeem closed-ended shares, look at me, 7, back to the open market where you bought them. Sell them back to the open market, either to the exchange or on NASDAQ, and receive the market price when you redeem as well. So what is now some of the characteristics, if you will, of closed-ended shares? Look up. These shares are issued by a management company that acted in a closed-ended capacity. When a management company acts in a closed-ended capacity, what does that mean? It is a one-time offering of those shares for sale to the open market. Once the number of shares in the offering have been issued, there are no more shares available for sale to the open market by the management company. Mr. Johnson, you want to buy shares in this fund? Buy them from the open market. You want to redeem shares out of this fund? Sell them back to and redeem them to the open market, because these shares may not be purchased from the management company or redeemed back to the management company. These are non-redeemable shares by the management company. Hear me so far? Because you're buying these shares from the open market and redeeming them back to the open market, you will pay the market price. Are you with me so far? Yes. Now, look at me. Listen carefully. Investors on this side of the room, you bought one share in a closed-ended fund. Are you with me so far? That fund has 38 stocks representing the package of the underlying portfolio built into that fund. You bought one share. Investors on this side of the room, you bought one mutual fund share in a mutual fund or an open-ended fund. Are you with me so far?
Yes.
In that fund, there is a package and an underlying portfolio of 38 stocks as well. Different funds. Are you with me so far?
Yes.
Same number of securities. Are you with me?
Yes.
Look at me, please. Your one share of ownership in that one closed-ended fund and your one share of ownership in that mutual fund represents the same equity ownership. Your one share, respectively, in your respective funds owns the same percentage of each one of those 38 stocks, equally and undividedly. There's no difference in an investor's equity ownership in the fund when he buys into a closed-ended fund versus when he buys into a mutual fund. So then, what is the difference between closed-ended versus open-ended funds? Are you with me so far?
Yes.
How and where the shares are bought and sold, and whether or not the shares are or are not redeemable by the management company are the only differences. Are you with me so far?
Yes.
Again, in summation regarding the characteristics and some of the regulation that NASDAQ seeks. Are you with me so far?
Yes.
Open-ended shares is a continuous open-ended offering of those shares. Dreyfus is constantly issuing and selling those shares to the open market on an open-ended continuous offering basis. Are you with me so far?
Yes.
Shares, they stand ready to issue to you and directly, mutually buy back from you when you want to redeem. Are you with me so far?
Yes.
These shares are made up of only common by type. Are you with me so far?
Yes.
And the pricing of these shares is made up of the true value of what the fund is worth, and we'll get into the true value in a moment, known as the net asset value on a per share basis, also called NAV. We'll get into pricing in a moment. Closed-ended shares, completely different now. No difference in equity ownership. You're going to be so far to the investor is a one-time offering of those shares to the open market. After the sale, it is a closed offering there are no more shares available for sale by the management company to the open market regarding shares in this fund. Buy shares in this fund, buy them from the open market, redeem out of the fund, redeem back to the open market. Are you with me so far?
Yes.
And therefore, because you're buying them from the market and redeeming them back to the marketplace, the components that make up the price of one closed-ended share purchase, are you with me so far,
yes,
are made up of the market price. Now let's get into valuation. Are you with me so far?
Yes.
Those are the characteristics of open-ended shares versus closed-ended shares. I ask you to turn your attention here to the true value of what every fund is worth. Listen to what I said to you. Every fund. That means whether I'm talking about closed-ended funds, closed-ended shares, or mutual funds, open-ended shares, the net asset value on a per-share basis is the true value of what every fund is worth. Reported in the paper every single day. Let's take a look at why the NAV per share represents true value right here. When you go to the financial section of the prospectus of any fund, are you with me so far?
Yes.
You're going to see a section there in the financial section called the expense ratio of the fund. Please listen to me. I don't want you to look there. I want you to listen to what I'm saying to you. Now listen to what the expense ratio of a fund means. Every time clients give orders through you, the broker, or maybe they go directly to the management company if it's an open-ended fund, to buy shares in that fund. Are you with me so far?
Yes.
Clients want to invest money in a fund. And furthermore, every time clients want to redeem and receive proceeds by liquidating out of a fund, the IA, who is the manager of the fund, goes into this trading mode. Are you with me so far?
Yes.
He starts buying shares for investors and receiving investor capital when clients want to accumulate and go long. And when clients want to redeem, he starts selling shares out of the fund and sending clients sale proceeds. These are liquid investments. You get your money out in 72 hours. The third advantage of investing in funds is Series 7 is their liquidity. Are you with me so far? They're very liquid investments. You get your money out in 72 hours. You get a check. Are you with me so far?
Yes.
Mailed right to your house. Great investment. So what happens when clients are accumulating and redeeming? The IA of the fund, who's the fund's manager, look at me. He's going into this trading mode right now. He's buying shares for clients who want to go long. He's redeeming shares out of the fund and sending clients their sale proceeds. And that means that the expense ratio of every fund is measuring the trading costs of the fund. Are you with me so far?
Yes.
Now, look at me. I want to net out those trading costs of that fund. I want to remove the trading costs of the fund. Remove them out of the fund. Are you with me so far?
Yes.
And just look at the assets, which are the dollars that are invested by shareholders in that fund. That's the money invested in the fund. Let's say it's $200 million that's invested in 42 stocks. And we look at the closing values. The word values means prices of those 42 stocks. Every single day, which way those prices closed on the New York Stock Exchange. Are you with me so far?
Yes.
So what are we really looking at right now? Please look up. This is critical. We're removing out the fund's trading costs. We're just looking at the assets, which are the dollars that are invested in the portfolio, the package of 42 stocks, and their closing prices every single day. And if we divide that by the number of shares outstanding in the fund in the market, we get price per share. Agreed.
Agreed.
I'm going to do this again for you because you need to stay with me and increase your focus. Why is the net asset value on a per share basis the market price per share of what every fund is worth, also known as the true value per share of what the fund is worth? Because it's looking at the money invested in the securities and their closing prices every single day, divided by the number of shares outstanding, gives us price per share. Are you with me so far?
Yes.
The net asset value on a per share basis is the true value of what every fund is worth, known as the market price of the fund per share, because it's based upon closing values, closing prices every single day as of yesterday's close. Are you with me so far?
Yes.
It's looked at every single day by the SEC and the NASD. Are you with me so far?
Yes.
They're looking at the money that's invested in every fund and the closing prices that money is invested in, those 42 stocks, at the close of the exchange every single day. Therefore, if we divide it by the number of shares outstanding, which is the float, we get price per share, true value per share. The NAV on a per share basis is the market price on a per share basis of what the fund is worth. Are you with me so far? It is the true value of what the fund is worth per share based upon yesterday's closing prices that money is invested in that portfolio. Are you with me so far?
Yes.
And it also happens to be, and we'll save this for later, the bid price that the client receives per share when he redeems. Are you with me so far?
Yes.
Now, Let's talk about the client's cost basis when he goes along one share in a fund. He has to pay the public offering price known as POP. Are you with me so far?
Yes.
I'm about to show you what's very exciting about buying into mutual fund shares and what's also potentially and equally dangerous about buying closed-ended shares. Are you with me so far?
Yes.
When your client wants to go along and buy one mutual fund share, one share, I'm just using one share as an example, regardless of the number of shares he's going to eventually accumulate. Are you with me so far?
Yes.
The public offering price to go along one open-ended mutual fund share in a fund is based upon 7, the NAV on a per-share basis, true value plus a sales charge if it's a load fund. Sales charge, load, same language, means the same thing. Some funds, some mutual funds, some open-ended funds may have built into its prospectus a sales charge that charges the client to accumulate and go along when he buys into the fund. Look at me. When he buys into the fund. At the point of purchase. I'll say it another way. That would make that fund, Series 7, a front-end load fund. The word load means the sales charge that we may charge clients to buy into that fund. Are you with me so far?
Yes.
Because he's paying that sales charge, because it's a loaded fund, at the point of purchase, it's called a front-end load. Are you with me so far? Are you with me so far?
Yes.
Some funds are a no-load mutual fund. They don't charge the client a sales charge to buy into the fund. Are you with me so far?
Yes.
Well, you're not recommending this particular fund because it's a load versus a no-load. Are you with me so far?
Yes.
Why do you recommend a particular fund? Because of the investment objectives of the fund and its performance. It's tied to the client's suitability requirements. Are you with me so far?
Yes.
If that particular fund, ranked by Morningstar in your due diligence, just happens to be a loaded fund, are you with me so far?
Yes.
Well, then so be it. But that's not why you're trying to eliminate recommending a no-load fund or a load fund because you want to save the client a sales charge. You're not looking to charge him that sales charge. But if that happens to be the fund that's performing better than other growth funds, in my particular example, regarding a client who needs growth investments, well, then it happens to have a sales charge, so be it. Are you with me so far?
Yes.
The misrepresentation in the marketplace is that for every transactional fee, if you will, that clients pay, look at me, they have this belief that it goes in our pockets as financial advisors. Are you with me so far?
Yes.
We're simply working for an agency commission here. Are you with me so far?
Yes.
Because mutual funds may not be bought and sold and traded under the Investment Company Act of 1940 on a principal basis. Are you with me so far?
Yes.
They must be executed on an agency basis, so we'll get into why later on in a moment they can only be executed agency and not principal. Are you with me so far?
Yes.
But you need to communicate to the client. He says, yeah, but it's got a sales charge attached to buy into the fund. I know, Mr. Johnson, but look at the investment objectives and the returns that the fund is generating. That's why I'm really recommending the fund to you. Well, aren't you making enough in the form of an agency commission of a 5% commission above the offer price of the public offering price that I'm paying to go long a position in the fund? Mr. Johnson, the agency commission is what I'm working for every single day to change your financial life and net worth. The sales charge that the fund is charging doesn't go in my pocket. He thinks it goes in your pocket. He doesn't know. Who is the sales charge for? Yeah, the IA. You have to pay for expertise. Are you with me so far? You have to pay for the expertise. These fund managers like Dusseldorf and Cook and Mickey Cantor, the Tudor Fund, are very prestigious individuals that manage billions of dollars in assets that are invested in a portfolio. And so that's why when you look at the top of the prospectus of every fund, are you with me so far? You see this, and I'll read this one to you. Munder, Class A shares, B shares, C shares. What's with the ABC category? What the hell's going on here? Well, the A shares represent shares in the fund known as the A fund of a portfolio that's managed by the key investment advisor, who's that star fund manager. Are you with me so far?
Yes.
That usually has a load charge attached. So what if you wanted to invest client in the same portfolio of securities? Are you with me so far?
Yes.
But without paying the load. Invested in the B shares of the same fund. It models its trading activity after Paul Cook, who's managing the A shares of the same fund. Are you with me so far?
Yes.
Without the load. Are you with me so far?
Yes.
So you want to pay for expertise? And you want to have Paul Cook manage your assets? Good. It's a 5.5% front-end load. Are you with me so far?
Yes.
We'll get this language now, but look at me for a minute. And so I look at the true value of what every fund is worth, plus a sales charge if it happens to be a front-end load. Are you with me so far?
Yes.
These are the two components. Get to know them intimately right now. That make up the cost basis, which is the public offering price that your client pays to go long one share in a fund. Are you with me so far?
Yes.
One share in a mutual fund. Are you with me so far?
Yes.
One share in an open-ended fund. Are you with me so far?
Yes.
Now, what else is the NAV also known as? What did I tell you? Look up. You need to be really focused right now. It also happens to be the bid price that the client receives when he gives you an order of redemption at the time of sale. Are you with me so far?
Yes.
What is the offer price? It is the public offering price. That's the price the client pays to go long one share in a fund. Am I right?
Yes.
In a mutual fund. That's known as his public offering price. And isn't that the price that the client spends that represents capital risk that establishes his cost basis? Please say yes.
Yes.
Look up! Here's what's exciting about buying into mutual funds. Watch this now. Look up. Fix that eye, Priscilla. Look up. I'm going to wait for you, darling. Look up. It is a no-load mutual fund purchase. The offer is equal to the bid price, and 100% of the client's cost basis is equal to 100% true value, because the true value of what every fund is worth is known as the NAV on a per share basis. He's not buying it overvalued. He's not buying it undervalued. He's paying a price known as his cost basis, public offering price, that's made up of exactly the true value of what the fund is worth based upon yesterday's closing prices. Wow! Are you with me?
Yes.
That's something. Every fund has a reported NAV to the paper every single day, and that's the market price of what the fund is worth based upon yesterday's closing values and prices of those 38 stocks. Is that agreed?
Yes.
However, when you buy closed-ended shares, where do you buy those shares from? What do you pay when you go long? Market price. And so, I want you to look at the components that make up the purchase price for one closed-ended share that the client wants to buy. Stay awake. Look at me. Are you with me?
Yes.
What is it made up of? Market price, because that's what you pay. That represents your cost basis when you go long one closed-ended share. Am I right?
Yes.
It's executed, closed-ended share purchases on an agency basis. So what do you think the transactional fee is that we charge clients? A commission. Are you with me so far?
Yes.
What's the transactional fee that we charge clients associated with the execution of mutual fund shares? Load charges, if it's a front-end load. Are you with me so far? What is the transactional fee that we may charge clients to buy closed-ended shares? Commissions. Are you with me so far?
Yes.
Now, this closed-ended fund. What is the most prestigious closed-ended fund in industry? What's the name of that fund? No, Sequoia. Who's Sequoia? Buffett. One share was auctioned off on eBay not too long ago for more than $5,000. The fund has been closed out for sale to the open market since 1956. Are you with me so far?
Yes.
Right. Well, every fund, are you with me so far?
Yes.
Has an NAV. And the NAV is the true value on a per share basis what every fund is worth. Am I right?
Yes.
Even this closed-ended fund has an NAV reported in the paper. And so here's the NAV of the fund. Closed-ended fund. But the NAV is not a component that you're paying that makes up the purchase price when you go long one closed-ended share. What is the component known as? Market price. How many times have I taught you in taxation last Friday that just because the security is trading at a certain price does not mean it's worth that price? Are you with me so far?
Yes.
Just because the stock is trading at 76 1/4 or 13 5/8 doesn't mean it's worth 76 1/4 or 13 5/8. That's the market price, the price that people are willing to pay when they trade a position in the security. Buyers and sellers set by the forces of the supply and demand. Am I right?
Yes.
So if the market price has nothing to do with the true value, what does? The price-earnings ratio and the earnings multiple of the company tied to the earnings. And based upon your interpretation of PE, that will determine whether 76 1/4 or 137 5/8 is overvalued or undervalued. Am I right?
Yes.
So what happens if you buy into a closed-ended fund and you're paying a market price that's trading at an inflated premium to the NAV of that closed-ended fund? You would be buying in overvalued. You should also argue. What happens if you buy one share in that closed-ended fund and you're paying a market price that's trading below the NAV of that fund? Market price and NAV are two different financial concepts. Are you with me so far?
Yes.
NAV is the true value of the fund is worth. Market price is the price the security is trading out there in the secondary market. Are you with me so far?
Yes.
So here, you could be buying it overvalued to the NAV of that fund, closed-ended fund, or undervalued to the NAV of that fund. There is volatility here because market price is volatile. Relative to the true value of what the fund is worth. Here, the offer price is made up of 100% the true value of what the fund is worth because the true value of what every fund is worth on a per share basis is known as the NAV on a per share basis. Are you with me so far? Yes. NAV is everything conceptually here associated with mutual fund trading. Are you with me?
Yes.
So the client says, listen, you've been talking with me for 6 weeks about buying into this international technological fund or this net fund or this blue chip fund. Are you with me so far?
Yes.
It is a mutual fund. Okay, I'm going to give you $100,000. Go long and buy these funds. Buy as many shares as you can. Are you with me so far?
Yes.
Execute the order now and call me before the close. Sorry, I can't do that. You can't do that. We're talking about this investment for 6 weeks. I'm ready to go now. I'm ready to give you a $100,000 cost basis investment. Now you can't do that? What do you mean you can't do that? I don't understand. You see, under the Investment Company Act of 1940, that regulates the buying and selling and trading of mutual fund shares, I must wait for the market to close, for those values to be established, so that your NAV, which makes up your offer price when I go long mutual fund shares, must be set the forward NAV price, which won't be determined until the close of the marketplace today. Now, because we have after-hours trading, I'm glad to execute this order for you at 4:05 or for any time after the close, but I have to wait until the market's closed because the PLP that makes up the NAV that NAV must be the forward NAV on the Series 7 buy side, on the buy side. When he's buying and going long, that is not just NAV, any NAV in the marketplace, it is the forward NAV, which won't be determined until 4. I got to wait for closing values. Are you with me so far?
Yes.
It is prohibited to buy and sell and trade mutual fund shares in the middle of the trading day. Are you with me so far?
Yes.
You have to wait for closing values, and therefore the NAV that makes up the offer price to go long is the forward NAV. Are you with me?
Yes.
So, in summation with respect to pricing, PLPs do the NAV plus SCF load for mutual fund share purchases. Am I right?
Yes.
PLPs do the market price plus commission for closed-ended share purchases. Agreed?
Agreed.
So, let's talk about, there's the NAV, forward NAV to go long. Are you with me so far?
Yes.
Let's go back to this sales charge, shall we? He said, but I got a couple of $1 million with you. I got $750, $500,000, $250. Listen, I could have $20,000 invested with you in a marketplace where there's a lot of illiquidity going on, and I pay you nice commissions. You deserve it. You're giving me nice returns. I got to tell you, my wife and I were just not happy about the load. I don't want to pay the load. I don't want to pay any more transactional fees or fees to Wall Street than I have to. Well, listen, I totally understand that. Maybe I can look for another fund that might give you the kind of returns that this particular fund is giving you. That's a no-load mutual fund. You do your due diligence, but what happens if you can't find something like that in the market just yet at that point? Are you with me so far?
Yes.
Mr. Johnson, this is the fund for you. I got to tell you, for all of the right reasons in your due diligence. But I would like to soften the blow a little bit and reduce the load if I can. Most funds that have a sales charge attached on a front-end load have also built into the prospectus a breakpoint schedule. I didn't say break even, I said breakpoint schedule. Now this is a schedule, Mr. Johnson. If you go to your schedule, I'll show you exactly what I mean. That entitles clients to a discount from the maximum sales charge based upon the size of his capital, his contribution. Are you with me so far?
Yes.
And by the way, look up. What is the maximum sales charge for a fund that's got a front-end load that we can charge the client? 8.5%. It is 9% for contractual plans when we get into that on Monday associated with annuities. Please listen to me. Are you with me so far?
Yes.
Right. So the max load is 8.5%. That's the maximum sales charge for a fund that's got a load charge attached to it when the client buys into the fund. Are you with me so far?
Yes.
So most funds that have a sales charge attached also have built into the prospectus a breakpoint schedule. Now the breakpoint schedule entitles your client what? To a quantity discount from the maximum load based upon, as I'll say again, the size of his capital contribution. So let's take a look at your breakpoint schedule, if you will, for a moment. And I want your eyes on the breakpoint schedule for a moment. Client A, Mr. Johnson, wants to give you $55,000, one lump sum capital investment to invest in that fund. Are you with me so far?
Yes.
Okay, so this client, I'm talking mutual funds now because I'm talking sales charges, am I right?
Yes.
So this client wants to give you $55,000, and what would the sales charge be there? Can you tell me? 4%, thank you, Spinelli. Which is a savings of 4.5% from the maximum load of 8.5% with a $55,000 capital cost basis investment. Agreed?
Agreed.
Are you with me?
Yes.
Look, I want to trade with you. I need you with me now. Are you with me?
Yes.
Client B wants to buy into the same fund, but this client wants to give you $125,000. What would his sales charge be? 3%. Look up. Two investors buy into the same fund. Are you with me so far?
Yes.
One client charged 4%, the other client charged 3%. Because one client's giving you $55,000, another client's giving you $125,000. Are you with me so far?
Yes.
If one client's sales charge is different than another, look up. Then the price that Mr. Johnson pays to buy one share, known as his offer price, is going to be different than the price that Mr. Finkelstein buys to pay one share and buy one share, known as their offer price, will be different. Am I right?
Yes.
Why? Because look up. The sales charge is part of the offer. If your sales charge is different than your sales charge because your capital contributions are different, well, then your offer price is going to be different than your offer price. With me so far?
Yes.
And why is it so important to establish your client's public offering price? Well, you need that for two reasons. One, what happens if down the road he gives you an order for a partial or a full redemption of his mutual fund portfolio for liquidity needs? And when you sell and redeem those shares out of the fund, the client's going to receive what? The bid price. What's the bid price known as here? The NAV per share at that time. Are you with me so far?
Yes.
And what happens if that NAV bid price per share was higher than his public offering price per share? What might you potentially generate for the client? Say it. Because you know what you just did? You just liquidated and redeemed the sale of a capital asset known as a fund by capturing a bid price that's higher than the offer. Are you with me so far?
Yes.
That's a capital transaction. Are you with me so far?
Yes.
So what's the first reason why you need to establish a client's public offering price? To determine for down the road in trading if there's the potential for a capital gain or a capital loss in the transaction. But there's another equally important reason why you must establish the client's cost basis. And why else? To know how many shares you're going to end up accumulating and go long in the position with a $55,000 or $125,000 cost basis. Am I right?
Yes.
You must find the offer first. You must find the price that he owns the security at. Are you with me so far?
Yes.
For two reasons. To determine how many shares he's going to end up owning in his portfolio, right?
Yes.
And then from a trade point of view, from a trade comparison, to determine that when he liquidates down the road compared to the offer price, there's a potential capital gain or a capital loss. Am I right?
Yes.
Well, one client's going to have a different offer than the other because one client's going to have a different sales charge than the other. The NAV is the same for both. The forward NAV on the buy side. Am I right?
Yes.
What you are now about to see, without calculation for NASDAQ, is learning how to find your client's public offering price. Because one client's going to have a different offer than the other. And why do we need to do that? Because you need to establish the client's cost basis, determine again, I'll say it again, how many shares he's going to go long in the position, and for trade confirmation, trading and tax purposes, down the road when redeems, what you have potentially generated in the form of a potential capital gain or a capital loss. This is now called finding the offer. Are you with me so far? Yes. Now, I don't want you to refer to the body of work that you have in front of you. I just want to do a trade with you. Are you with me so far? Yes. I want you right here. You have a client on the phone. And he says, listen, I really like this fund, and I agree with you for all the right reasons. I can free up about 20 grand. That's about all I got. Let's take $20,000. Watch this trade. Buy into that fund. I know you're going to wait until 4:05, execute it after the market closes, and let me know the price of execution. Done! He wants to know his offer price. You look into the prospectus of this particular fund, and you see that with a $20,000 cost basis, so you've been so far, your client's going to be charged a 7% load. Don't look at that breakpoint schedule. This is an isolated transaction. Are you so far? Yes. That's a 1.5% savings from the maximum 8.5% load with a $20,000 capital investment. You wait for the closing value of the NAV. It's now 4 o'clock. You see closing value. NAV is $10 NAV forward price. Are you with me so far? Once you know the cost basis, once you have the sales charge, and once you know the forward NAV, you can find any client's public offering price. Are you with me so far? I'm going to show you how to find the offer right now. To find the client's offer, the POP, you know, is made up of the NAV plus SC. Are you with me so far? What's his NAV here? It's $10. What's his sales charge? 7%. And we're going to find his offer price right now. Are you with me so far? Here's how you find the client's offer price. Are you with me so far? Watch this. You take the forward NAV, which is how much? Forward NAV, which is how much? Thank you, $10. Thank you. And divide the forward NAV by the complement of the load. What did I just say? I said divide the forward NAV by the complement of the load. Now, the word complement means 100% minus whatever criteria you're looking for, which is the other side. Are you with me so far? Yes. So, client in the 28% federal tax bracket, his complement is 72%. 100% minus 28% is the other side. Are you with me so far? Forward NAV by the complement of the load means $10 divided by 100% minus 7%, which means what? $10 divided by 93% gives you the offer of $10.75 POP per share. There's his cost basis per share. Now, what does this mean? Well, let me show you how fantastic mathematics are. You just found your client's offer price. The offer price is $10.75 POP per share. That's his cost basis for one share. You with me so far?
Yes.
He's going to give you how much? 20 grand. If this was a no-load mutual fund share purchase, and the forward NAV was 10, what's the POP? 10. And with a $20,000 capital investment at a cost of $10 per share, your client would go long 2,000 shares in the position. Am I right?
Yes.
Because 2,000 shares at a cost of $10 per share is 20 grand. Am I right?
Yes.
But I'm sorry, there is a sales charge, and therefore the sales charge is 7%, which represents what? 75 cents of the $10.75 per share. So with a $20,000 capital investment at a cost of $10.75 per share, POP per share, your client's approximately going to own, I think, exactly 1,872 shares. Because I believe that 1,872 shares at a cost of $10.75 per share should be about 20 grand. You with me so far?
Yes.
Now, what did you establish? You know his cost per share. Are you with me so far?
Yes.
Down the road, if you liquidate and capture $13.08 NAV bid price per share at liquidation, what have you generated for your client? Thank you very much. Now you also know From a trade confirmation, the ownership of the shares. What else do you know? The number of shares of the position, am I right?
Yes.
Which means that this 7% sales charge of his total cost of $10.75 per share sounds very hefty, doesn't it?
Yes.
But what does the 7% of his cost per share really represent? 75 cents per share transactional fees. 7% of his cost, which is sales charge, represents in dollars and cents 75 cents per share transactional fees in the form of load. Let's proof out that 7% of his cost of $10.75 per share is made up of sales charge in dollars and cents. $10.75 per share, of which $10 is true value. Are you with me so far?
Yes.
Which means what mathematically? It means, Mr. Johnson, do you realize, I know you're paying a 7% sales charge, but look at it this way. 93% of your cost per share of $10.75 per share is true value. 7% of your cost of $10.75 per share only represents 75 cents in the form of transactional fees. Oh, so it's only 75 cents per share? That's what the 7% means? Yes, because 93% of your cost that you're paying for one share of $10.75 per share is made up of true value. With me so far? So what we're proving right now is that the 7% sales charge only represents 75 cents transactional fees in the form of load per share. Take the POP minus the NAV, and what do you got? You have sales charge in dollars and cents per share, so that's $10.75, right? Minus $10, which means we know that his transactional fees per share are in the form of 75 cents per share in the form of load. Are you with me so far?
Yes.
What we're equivalating and proofing out mathematically from an accounting point of view, that 75 cents per share of his cost of $10.75 per share represents a 7% sales charge. Are you with me so far?
Yes.
So then take the POP minus the NAV, 75 cents. Divide that by the POP. What I'm asking you to do is take 75 cents and divide it by $10.75, and you're going to get 7%, which is an accounting proof. Mr. Johnson, 93% of the cost that you're paying for one share is made up of the true value of what the fund is really worth, because $10 is 93% of $10.75 per share. This 7% sales charge transactionally that you're paying, because it's a front-end load, only represents in dollars and cents to you transactionally 75 cents per share. It's the right fund for you. The load really doesn't represent that much of your cost basis. Are you with me so far?
Yes.
I think you should go with me right here at this particular level, at this particular recommendation, to see true appreciation, of course, in the dividend income you're going to earn from the fund. And so we see a little bit about the structure and the characteristics of open-ended shares versus closed-ended shares, valuation and pricing. And when you come back in 10 minutes, are you with me so far?
Yes.
I'm going to give you the menu for the remainder of this restaurant day. Are you with me so far?
Yes.
We are then going to go long and establish a portfolio and accumulate a position in fund and talk about accumulation plans. After we accumulate, we're going to redeem and liquidate out of the fund. Are you with me so far? And talk about redemption plans, and then we're going to move into the tax ramifications of mutual fund trading. So when you come back, I'm really going to light it up into accumulation, liquidation, redemption, and taxation. See you in 10 minutes. This is week 2 after all. Right?
Yes.
Right. Thank you.